Welcome back to the Globe Realty. Today, we're diving into one of the most unexpected shifts in the 2025 housing market, a trend that's catching landlords, investors, and even longtime residents off guard. In today's video, 10 California cities where apartment buildings are emptying out at alarming rates. We're diving deep into the quiet collapse unfolding behind the scenes. Using up-to-date rental market analysis, real estate trends, and fresh 2025 data, we break down why vacancies are exploding, where renters are leaving fastest, and the factors reshaping California's housing market in real time. And trust me, the final city on this list might change how you think about California housing entirely. Across the state, vacancy rates are climbing faster than experts predicted. Oversupply, migration slowdowns, stalled absorption, and affordability pressures are creating a quiet collapse, one that's showing up in empty units, slashed rents, and concessions landlords haven't offered in years. And here's the shocking part. Some of the cities experiencing the fastest exodus were considered safe markets not too long ago. So before we jump in, make sure you like this video, subscribe to the Globe Realty, and hit the notification bell so you never miss the data-backed breakdowns we bring every week. Let's get started. Number 10. Salinas, California. This one will surprise most of you until you peel back the layers. On the surface, Salinas is a quiet agricultural hub with steady population figures. But beneath that calm exterior, the apartment market is flashing some very real warning signs. According to recent data highlighted by Globest, several smaller California cities, Salinas included, are seeing above-average new supply combined with patchy, uneven demand, creating the perfect setup for apartment buildings that feel emptier by the month. And the big question is, why here? Why now? Well, think about it. Salinas rents surged during the pandemic when spillover from the Bay Area brought in remote workers and squeezed the local market. But fast forward to 2024 to 2025, and the dynamic has flipped. Now that many of those remote workers have either returned to major metros or moved out of state altogether, Salinas has been left with extra units and fewer qualified renters. Have you noticed how quickly the "for rent" signs reappear after someone moves out? That's not a coincidence. That's the market struggling to match supply with demand. At the same time, developers in the region, encouraged by earlier rent spikes, pushed through a wave of new multifamily projects. And while new construction is supposed to signal growth, here it's creating the opposite. An oversupply in a city where incomes haven't kept pace with rising living costs. So yes, buildings are technically new, but the renters simply aren't showing up fast enough to fill them. And here's where things get a bit controversial. Some analysts argue that Salinas is a textbook example of California's misaligned housing strategy. Cities built units assuming long-term demand from high-income transplants, but never considered what happens when that pipeline dries up. Others say the issue is deeper, that working-class locals have been priced out for years, and now that the market is cooling, landlords are paying the price for ignoring affordability. So let me ask you this. If a city can't keep its homegrown residents and can't rely on remote workers anymore, who exactly are these new apartments supposed to serve? And what happens when owners can't hit their occupancy targets? Lower rents? Conversions? Distress sales? Salinas isn't collapsing, but it is sending a message to investors across California. Even smaller cities aren't immune to the shifting tides of demand. And when supply rises faster than incomes or population growth, vacancies follow. Number 9. Merced, California. This too might raise a few eyebrows. How can a city with classic Central Valley charm show signs of apartment buildings emptying out? Well, buckle up, because the data reveals a very real risk. Merced has been on a serious growth trajectory, especially when you consider its affordable housing push. According to city planning documents, Merced's housing element has greenlit a number of projects, and there's even a brand new 108-unit affordable complex in the pipeline. In parallel, ABC 30 recently reported 9 different housing projects underway, including more than 150 units expected to open soon. That alone sounds promising, but here's where the warning bells start to ring. Absorption, or how quickly new units are being leased, hasn't kept up with this delivery boom. Some of these developments risk being underleased because Despite the population growth, demand from renters is uneven. The city's own housing needs assessment shows that out of more than 1,700 vacant units, 56.9% are for rent, meaning a large portion of new inventory is just waiting. Dig further, and Merced's rent story gets even more complicated. The average monthly rent is around $1,641 as of late 2025, a modest 1.6% rise over the previous year. Meanwhile, fair market rent for a two-bedroom has jumped to about $1,509, according to HUD estimates. That's not exactly cheap for long-time Merced residents, many of whom aren't seeing their incomes rise fast enough to comfortably absorb these rents. But the truly controversial part? Merced has both too much demand and not enough stable demand. On one hand, service providers say there's a lack of overall housing for people who need it. Long-term locals, lower-income residents, UC Merced students, and that some are being priced out or forced to look for more affordable places. On the other hand, the speculation and rush by developers may be overestimating how many new renters Merced can support long-term. So who's going to fill these apartments? And who's going to be left behind? Is this wave of new development a bold investment bet or a looming crisis? Number 8. Stockton, California. Stockton is surfacing on this list for some very real but nuanced reasons. Here's the deal. Stockton has long been a tertiary market favorite, more affordable than the Bay Area, but with proximity to major job centers. But lately, things are shifting. Renter demand isn't nearly as uniform as developers assumed it would be, and that's causing spots of oversupply and more volatile absorption. According to multifamily loan underwriting data, Stockton's broader vacancy has ticked up, even as average asking rent remains new development friendly. Consider the numbers. The average apartment rent in Stockton hovers around $1,672, and it's actually down slightly year over year by roughly 0.1%. That kind of flat or even sliding rent doesn't line up with a high demand boom. Zillow's data reflects this too. They report a 2025 average rent of $1,975. And while that sounds healthy, the uptick has been minimal, suggesting pricing power for landlords may be weakening. The controversial piece? Investors and developers are still pushing hard into Stockton. New apartment buildings are being constructed or financed under the assumption that this region will keep absorbing large volumes of renters. But absorption is uneven. The submarkets closest to the University of the Pacific are doing well. Student housing has near 100% occupancy, but in other newer projects, leasing is lagging. So who's getting left behind in Stockton's rush to build? Likely the lower or middle-income locals, people who already lived here, who may be priced out or simply not able to grow into these newer units quickly enough. The risk is real. Entire apartment projects could be underleased even if headline numbers don't scream crash. Think about it from a renter's point of view. If you're apartment hunting in Stockton, are you seeing more signs of competition or discounts? For an investor watching from the outside, you've got to wonder, is this wave of construction a smart long-term bet or an overconfident bet on growth that isn't as stable as it looks? That tension between belief in Stockton's growth and the reality of patchy absorption is exactly why Stockton earns its spot in our top 10 California cities where apartment buildings are emptying out. Number 7. Bakersfield, California. Bakersfield, another Central Valley city that's quietly creeping the lane of collapsing rent market. On paper, Bakersfield seems affordable and stable, but when you dig deeper, the data reveals a risk, a growing development pipeline and slower than expected leasing that could lead to underleased projects. According to Lee & Associates' Q1 2025 multifamily report, Bakersfield added approximately 340 new units just in the past year, with another approximately 320 under construction. Yet, net absorption over that same period was only around 203 units. That's not nearly enough to absorb all the new product being built, and vacancy ticked up to 4.9%. Meanwhile, average asking rent in the city is still low. The report shows it hovering around $1,368 per unit. Cosign's Q1 2025 market overview also backs this up. They say rents remained essentially flat quarter over quarter, averaging just over $1,350, even as more apartments come online. Here's where things get controversial. Despite these conditions, investors are still bullish on Bakersfield. Why? Because it's cheap, perceived as growth-friendly, and still more accessible than big coastal metros. But the real question is, can the city actually sustain this level of development without seeing a surge in long-term vacancies? When new units outpace renter demand, the risk of underleasing becomes very real. Local anecdote supports this tension. Some longtime residents argue that out-of-town investors are buying up older buildings, raising rents, and displacing people, all while building new developments that may not be fully occupied. The result? A polarized market. Legacy tenants squeezed, and new apartments waiting for renters who might not come fast enough. From a renter's perspective, you might see for rent signs staying up longer than expected, or concessions on newer buildings. For an investor, this could be a longer-term bet, but not without risk. Bakersfield has the affordability draw, yes, but the data suggests it's close to being over-leveraged if absorption slows even more. In summary, Bakersfield makes the list not because it's collapsing now, but because the structural risk is real. Oversupply, modest absorption, and investor optimism are creating the type of stress that could lead to emptying out in select submarkets. That's exactly what the Globe Realty is flagging in this rental reset. So what do you think? Is Bakersfield's bet on new construction smart, or is this a bubble waiting to leak? Let me know in the comments. Number 6. Fresno, California. While this one might not feel like a coastal boomtown, it's absolutely one of the more nuanced and quietly risky cities where the potential for emptying out is real. Here's what's going on. According to Lee & Associates, Fresno's multifamily vacancy climbed modestly to 4.3% over the past year. On the surface, that's still lower than many places, but it's not a signal of runaway demand either. The same report reveals that 630 new units were delivered recently, but only 840 were absorbed. And crucially, older Class B and C buildings actually lost renters. That means people are disproportionately gravitating toward newer, more affordable inventory, while older stock risks being underleased. Collier's Q3 2025 data backs this up. Average asking rent in Fresno is about $1,470, and while that's low for California, rent growth has slowed to just 1.6% year over year. Meanwhile, construction has pulled way back. Only 96 units are underway, a steep drop from the 1,600-unit peak in 2021. So why are we flagging Fresno on our empty buildings list, instead of celebrating it as a cheap, stable market? Because of something controversial. Not all demand is created equal, and not all of it is sticking around where it matters most. According to a deeply detailed housing market analysis, new 4- and 5-star properties, the high-amenity projects, are seeing vacancy rates around 11.1%. That's a red flag. Newer, higher-rent buildings that were supposed to command premium rates are struggling to lease up fully. On the ground, investors are still funneling money into Fresno's multifamily market, drawn by its relative affordability and renter-friendly profile. But how sustainable is that when rent growth is dragging and only a specific segment of properties is absorbing demand? If fewer renters pursue older apartments, those properties could see serious stress. And if 4- and 5-star rentals don't fill, some projects might underperform or even become distressed. From your perspective, as a renter, an investor, or someone who just watches the market, this is a moment to pay attention. If you're apartment hunting, you may find generous concessions on newer or luxury units as owners scramble to hit occupancy targets. If you're an investor, the question becomes, is Fresno's promise of cheap but stable worth betting on long-term, or are you walking into a long payback period? That's precisely why Fresno lands at number 6 on this list. The fundamentals are not collapsing, but certain dynamics make some buildings vulnerable in a way that few are acknowledging. And that's the kind of rental reset the Globe Realty doesn't want anyone to miss. So tell me below, do you think Fresno's slower rent growth and uneven demand are just short-term blips or the beginning of a deeper problem? If you are finding this video eye-opening, do me a favor and hit that like button, subscribe to the Globe Realty, and turn on the notification It will help us reach out to more people who equip themselves with real insight into real estate before investing. And now, the top 5 on this countdown. Number 5. Riverside, San Bernardino Metro, California. Coming in at number 5 on our list is the Riverside and San Bernardino Metro, yes, the Inland Empire, and it's here for a reason. The flood of new apartments is massive, and while demand has been strong, it's not keeping pace everywhere. That imbalance is creating real risk, not just for investors but for the long-term health of entire buildings. Check the facts. According to Marcus and Millichap's 2Q 2025 multifamily report, the Inland Empire saw a huge inventory surge recently. While there is solid net absorption, it's being pressured by record levels of deliveries. Meanwhile, Institutional Property Advisors reports the vacancy rate dropped to 4.3% in March 2025, which looks good until you realize how much supply is still swinging in. Matthews' Q1 2025 report shows there are 4,386 units under construction in the Inland Empire alone. With so many new properties coming online, even the historically strong renter demand is being tested. CBRE's data for Q3 2025 reveals that occupancy dipped slightly from earlier quarters as that new supply hit and made leasing more competitive. Here's where it gets controversial. Yes, people are moving into Riverside and San Bernardino because rents are more affordable than LA or Orange County, and that in-migration is real. But many of these newcomers are chasing newer, high-amenity apartments. What happens to the older or mid-tier units when everyone piles into the shiny new buildings? Some of those older projects may struggle. You might already be seeing vacancy creep in submarkets, or owners offering concessions just to hit occupancy targets. If you're a renter in the Inland Empire, you could end up with pretty attractive deals on newly built units, but only if landlords are willing to drop price or offer incentives. And if you're an investor, this is a moment to be cautious. Your underwriting better account for slower leasing in certain submarkets, or risk being stuck with underleased buildings. That's exactly why Riverside San Bernardino earns its spot at number 5 on this list. The growth story is powerful, but so is the risk. With so much new apartment construction coming online, pockets of emptiness are not just possible, they're increasingly likely. So here's a question for you. Do you think demand will absorb all these new units, or are we looking at a supply-driven reset in the Inland Empire? Let me know in the comments. Number 4, Los Angeles, California. At number 4 is Los Angeles, but not all of LA. Specifically, we're talking about select high-end submarkets where luxury buildings are beginning to creak under the weight of oversupply and cooling demand. This isn't just a coastal calm. In these 4- and 5-star towers, there are real cracks forming. Here's what the data shows. In Q3 2025, Matthews reports that LA's overall multifamily vacancy rate shot up to 5.3%, the highest we've seen in years. But that average hides something far more troubling. In premium submarkets like downtown LA, vacancy in luxury buildings is as high as 10.9%, according to the same report. These are not just any apartments. These are high-amenity, high-cost units that were supposed to be safe, recession-proof plays for investors. Digging deeper, recent research from McGill Invest confirms that luxury 4- and 5-star units in LA currently have a vacancy rate of 8.7%, down a bit from 10% in Q2 2023, but still wildly elevated compared to lower-tier housing. In contrast, more affordable older units, 1- and 2-star apartments, are sitting at just about 4.3% vacancy, meaning demand for lower-cost housing is far stronger. So why is this happening? Despite strong investor optimism, something controversial is surfacing. Many of these high-end buildings were built assuming that high-earning renters would flood in. Instead, that bet feels overheated. According to Marcus and Millichap's 2Q 2025 report, roughly 30% of downtown units are now offering concessions just to hit occupancy, a major red flag. When prime towers are giving away rent breaks, you know demand isn't keeping up. From your perspective, if you're apartment hunting in LA, this might be your opportunity. New luxury buildings could be offering better deals, more concessions, or flexible terms. But as an investor, this is a high-wire act. Underwriting on ultra-premium units just got a lot riskier. especially if the new supply continues to outpace demand in these high-cost neighborhoods. Ultimately, Los Angeles makes our top 10 list not because the entire market is collapsing, but because the luxury segment is stretched thin, strained by overbuilding, soft absorption, and more generous landlord incentives. That's exactly the kind of rental reset we at the Globe Realty are tracking, and it's not just coastal cities that are feeling the heat. So here's my question for you. Do you think luxury renters will come back, or is this a long-term supply hangover in LA? Drop your thoughts below. Number 3. Sacramento, California. Sacramento. This might feel counterintuitive at first, because Sacramento still looks like it's growing. But here's the reality. New apartment buildings are being delivered at a breakneck pace, especially in downtown and high-amenity cores, and leasing hasn't kept up across all segments. The result? Elevated vacancy in some of the very buildings that were supposed to be the crown jewels. Mid-2025 data shows Sacramento's apartment vacancy rate hovering around 6.7%, well above its historical 10-year norm of 4.9%. That jump is not uniform. Luxury 4- and 5-star apartments suffering the most, with vacancy rates near 11.8% in that class. Yet the more affordable workforce housing, 1- and 2-star, properties are doing much better. Their vacancy is about 4.8%, roughly in line with pre-pandemic levels. Where the pain is most acute is in pockets like downtown Sacramento and West Sacramento, which have seen the bulk of new luxury construction. In downtown alone, vacancy is around 10.1%, and in West Sacramento, it hits 13.3%. That's not a rounding error. That's tens or even hundreds of units sitting empty in buildings that were supposed to be high demand, high payoff bets. Why is this happening? Well, rentals in Sacramento's core are now facing a brutal supply wave. The 2Q 2025 report from Institutional Property Advisors shows that supply pressure is still concentrated in those same submarkets, and employment growth is slowing, especially for white-collar roles. In other words, Sacramento is growing, but not necessarily in the way that supports ultra-premium luxury leasing, while demand for cheaper, more efficient apartments is much stronger. On the investor side, this is a lightning rod moment. You could argue that developers overbet on Sacramento's urban core, assuming that luxury renters would keep coming. But now, many high-end units are offering concessions or staying on the market far longer than expected. Some owners are stuck. Do they lower rents aggressively or ride it out and hope for a market rebound? Meanwhile, investors looking for long-term cash flow may rethink underwriting these high-vacancy towers. From a renter's perspective, there's a silver lining. High-end apartments may be more negotiable now than ever, and if you can wait, you might score a deal in a building that was once considered too glamorous. But ask yourself, is this a temporary lease-up lull or a deeper realignment in how Sacramento's growth actually plays out? That's exactly why Sacramento lands at number 3 on the Globe Realty's list. The city isn't collapsing, but it's wrestling with a bifurcated market where luxury supply and demand are wildly out of sync, and that misalignment could lead to real trouble for high-end developers and investors. Number 2. San Jose, California. Number 2 on our countdown is San Jose, and this one cut deep. The same region once seen as the unstoppable heart of tech now faces serious cracks in its high-end multifamily market. With layoffs, shifting work habits, and sharply segmented demand, some of its newest and priciest apartments are sitting noticeably empty. Here's what's happening. The tech shakeout continues to ripple through the Bay Area. According to CRESA's Q1 2025 report, the San Jose MSA saw its unemployment rate rise to 4.3%, with 5,900 jobs lost year over year. Venture capital deals are down. R&D space is being rethought. CBRE says that Silicon Valley's R&D vacancy reached 11.7% in Q1 2025. That's not just empty offices, it feeds into how many potential renters there actually are for the top-tier, high-amenity apartments. Here's where it gets controversial. Investors poured massive capital into luxury multifamily in San Jose, betting that top-paid engineers and execs would gobble up every new development. But now, that logic feels shaky. Some of those luxury or premium buildings are struggling to lease up because demand is no longer as steady, and the type of renter who could afford them is shrinking. That's not the case everywhere in the Bay Area. but in Silicon Valley, this mismatch is real. On the flip side, we're seeing more people gravitate toward lower or mid-tier housing. The flight to affordability is very real. Residents who once chased proximity to work are now questioning why they're paying a premium for a building half empty next to pricey offices. If you're a renter looking in San Jose right now, you might find newer luxury units with concessions or more flexible leasing terms. Deals that would have seemed unthinkable a few years ago. And for investors, this is a high-wire act. Underwriting on ultra-prime apartments in San Jose feels riskier than before. If new supply continues, but the high-income renter base doesn't rebound, some of these high-end buildings could struggle with occupancy for years, not just months. That's precisely why San Jose Silicon Valley lands at number 2 on this list of California cities where apartment buildings are emptying out at alarming rates. It's not a crash across the board, but in the most ambitious luxury submarkets, the risks are mounting as demand softens and the tech foundation shakes. Number 1, San Francisco, California. Yes, even the famously dense and in-demand Bay Area capital hasn't escaped the rental reset. In certain luxury and downtown submarkets, entire apartment buildings are still feeling the pain. Here's the tough truth. After the pandemic, San Francisco saw its vacancies skyrocket, by some estimates to over 10% in parts of the city. That was the shockwave. Remote work, corporate flight, and people leaving expensive downtown towers. But the rebound hasn't been even. While newer demand is flowing back, it's concentrated in specific segments, and not all buildings are catching that wave. As of Q1 2025, San Francisco's vacancy rate was 5.3%, according to Matthews. Sounds like a recovery, and in some parts it is. But that citywide average masks a deeper divide. Class B and C units, the more workforce apartments, are seeing tighter occupancy, approximately 4.5 to 4.7% vacancy, while ultra-premium Class A towers are still under real pressure. What's more controversial, a huge source of risk for landlords right now is in those very luxury buildings downtown. These were built assuming high-paid professionals would return full force, but demand hasn't fully materialized. With massive office vacancy, CBRE reports office vacancy in Q1 2025 was 34.7%. The spillover hasn't translated into full leasing. Still, it's not all doom. San Francisco's multifamily recovery is gaining strength. Net absorption recently hit 3,700 units over the past year, and asking rents are rising again. Matthews reports a 6.1% year-over-year rent increase, pushing average rents back above 2019 levels. And some of that rebound is being driven by a surprising force. AI companies moving in, return to office policies, and institutional investors doubling down. That said, the city is still wrestling with a controversial trade-off. On one hand, investors and landlords are excited. Demand is re-emerging, and office-to-residential conversions are being eyed more aggressively. San Francisco could convert more than 61,000 office units into housing, according to an Axios-cited analysis. On the other hand, luxury buildings that were supposed to be safe bets could face long-term underleasing if this segmented recovery slows or a new wave of supply arrives. So why does San Francisco top our list? Because the city's comeback is uneven, and in its most glamorous towers, the risk of emptier floors remains very real. The quiet collapse isn't over, it's just changing shape. Here's my question for you. Do you think San Francisco's luxury apartment market will fully rebound, or is this recovery just a mirage for high-end developers? Drop your thoughts in the comments. And there you have it, our full countdown of the top 10 California cities where apartment buildings are emptying out at alarming rates. From smaller Central Valley markets like Salinas and Merced, to tech-shaken hubs like San Jose, and finally the high-stakes luxury towers of San Francisco, the story is clear. California's rental market is shifting faster than many expected. We've seen how oversupply, uneven absorption, affordability pressures, and shifting demand are leaving pockets of emptiness, even in cities long thought bulletproof for investors. This isn't just about numbers, it's about real people, real renters, and the changing dynamics of urban life in 2025. Some neighborhoods are bouncing back, others are struggling, and the market is demanding that investors, renters, and watchers alike pay close attention. If you're apartment hunting, This is the perfect time to spot opportunities. Think concessions, flexible terms, and units that might have been out of reach just a year ago. And if you're an investor, it's a wake-up call. Location and segment matter more than ever, and the luxury, high-end bets are no longer guaranteed. California's rental reset is here, and whether you're looking to rent, invest, or just understand the market, staying informed is the key. If you found this video insightful, make sure to like, subscribe, and hit that notification bell so you don't miss our future breakdowns of real estate trends, housing crises, and market opportunities. And I want to hear from you. Which city surprised you the most? And where would you watch carefully in 2025? Drop your thoughts in the comments below and let's discuss. Thanks for watching the Globe Realty, where we dig deep, break down the data, and help you see the stories behind the numbers.